Hello, everyone, and welcome back to another episode. I'm your host, a millennial investor. And if we look at my portfolio here and we scroll down and we look at all the lists of companies, I was looking at what are companies that I hardly ever talk about in my portfolio. What are some boring dividend stocks that I love receiving forms of cash flow from that I hardly ever mention? And we're going to talk about one that I've never really talked about a whole lot on the channel, but I've owned it pretty much since day one. We're going to talk about Verizon. It's had a recent downturn here in the last couple of weeks, and I really think that now is the best time to be buying a stock like Verizon. So in this video, we'll go over all the things that have to do with the company, why I'm buying the stock like crazy at these levels under $55 a share, and anytime the price goes lower, if this would go under $50 a share, I would be very excited because it would give me some great buying opportunities. And in this video, we're going to go over some performance ratings, comparing it to the S&P 500, as well as some other investments as well using Portfolio Visualizer and Google. And then we'll look at lots of other things with Verizon, including their fact sheet posted on their investor relations page, also looking at their previous annual report, looking like operating revenues, operating income, their total assets, looking at other things as well, including performance reviews and free cash flow, and lots of other things, including their dividend payments, which I find oh so important. But if you're new to the channel, if you're not familiar with me, my name is Jordan. I track my annual and monthly dividend income through these two charts right here. We have about $300 worth of annual dividend income and received about $31 last month through the form of monthly dividend income. And then we also have my portfolio value and my monthly YouTube income that I track every single month, and I'll be updating these in the very next video. So thank you guys for tuning in, and if you want to see the 24 companies that I own, they're listed on this little ticker chart right here. These 24 companies are the one that I own, including Verizon, and they're also listed in my portfolio right here, which is also shared down below in the description through this link right here. And speaking of being shared down below in the description, if you check that description out, you will get $30 just for getting signed up with M1 Finance. That's right, if you just download this link, deposit $100, you get $30 just for signing up. So we've had 79 people sign up through this little part right here, and all 79 have said that they love it. They enjoy M1 Finance. They enjoy their free services. It's one of the best brokerages out there in my opinion, and I 100% stand behind this company. So if you want to get signed up with this brokerage, you can get $30 just for getting signed up today. And my portfolio as a whole has done very well since starting it back in April of 2020, and now going all the way to February 1st of 2021. I think that this portfolio has a lot more room to grow as we steadily get more referrals, more money through that, as we get our dividend payments, and I continually make that $100 deposit every single Monday. This portfolio just continually has a compounding effect. Like if we look in January, let's just go back to January 1st, if we can find it right about here. In January 4th, we deposited $100. We invested it. We then received a dividend from Kimberly-Clark. We then scroll back down, we see we got another dividend from Pepsi. We got a referral. 1, 2, 3, 4, 5 different referrals. There's $150. We received a dividend payment from Altria. I deposited $100. I received 3 dividend payments in the same day from Realty Income, Store Capital, and my third real estate company, WP Carey, my big payer. And then I received 2 more referrals. That's $60. I threw in $100 on Monday. We reinvested it. Referral, deposit, dividend. You see how this pattern steadily increases itself, and that's what causes this portfolio to continually go up and up and up, and we are now on the brink of $10,000, and it's because of companies like this. Verizon is no exception to this. While we might be down on the company in the long run, we're currently down 6.77% on it. We have a negative $10 market gain and a $4.20 positive earned dividends return. And this, as a dividend investor, gives me an opportunity because when I look at the shares that I own, I currently own a little over 3 shares of the company at an average share price of 58 bucks. But right now it's trading at 55. And I'm going to give you my reasons why I think Verizon is at an absolute steal right now at an incredible dividend yield, which by the way, this number is incorrect. Ignore this number. I'm not sure why it says that. It's currently trading at over a 4% dividend yield, getting close to a 5%. So with Verizon, not only does it have an incredible dividend yield, but it also has an incredible opportunity moving forward. And that is especially with 5G. 5G gives Verizon a huge opportunity to increase its revenue, increase its free cash flows going into the 2020s. 5G is going to be massive for all telecommunications company and cell phone providers alike, and this gives Verizon just one more edge and one more growth opportunity going in towards the next decade. But let's forget 5G for a second because trying to predict numbers and revenues off of 5G is really hard to predict because it's just now starting to roll out and it's hard to give you the type of estimates that are actually going to be accurate, but we know that 5G is going to be huge for all companies alike, including Verizon. So that will definitely boost the company. But before we talk about the opportunities with Verizon moving forward, I want to look at track record. And what I did is I went ahead and looked at the last 15 years of performance. I went ahead and went 15 years back in 2006 and went all the way back to today in the beginning of 2021. Which, by the way, I want to mention, this also concludes that Verizon has actually went on a downturn recently in the last couple of years, and then SPY, S&P 500, is actually at its all-time high. So just keep that in mind. When we look at this, let's go to the beginning of 2006, right about here, about $30 a share. In that time, Verizon has went up 82%. Okay, that is not dividends, that is just share price. It's went up 82% in share price. But when we look at SPY, S&P 500, let's go to the beginning of 2006, right about here, and then we go to today, it's went up 192%. A better outperformance, right? Well, you're probably thinking, okay, if I were to invest in both of these in 2006, I would probably have a lot more money investing in the S&P 500, right? 82% versus 192%. That is a far better performance for the S&P 500. Well, what I did is that I went to Portfolio Visualizer, and what this does is this factors in what your performance would be if you reinvest your dividends. So we're starting in 2006, and we're going towards 2021, where we're at today. We're going to invest an initial amount of $10,000. This is not a recurring investment, just throwing in $10,000, set it and forget it, throwing it in at the beginning of 2006 and seeing what it would be worth today. No cash flows, no rebalancing. We're going to reinvest the dividends, okay? And we're going to compare this versus SPY, the S&P 500. So what we're going to do is we're going to scroll down here. We're going to click Analyze. And from January 2006 to January 2021 to today, if we go ahead and look down here, Verizon actually beats the S&P 500. And the reason that is because of those steady, incredible cash flows. And over time, while you get these dividend payments, you can see the portfolio income steadily increases from Verizon. This is what your $10,000 investment would look like. The first year, you would only receive $548. The next year, $604, $673, $755, $800, $900, $1,000, $11, $12, $13, $14, $15, $16, $17, $1,800 worth of annual income. And that's all just from investing in Verizon. Because not only do you get to reinvest those dividends, but they increase them every year. And that is why you're actually able to beat the S&P 500 if you were to invest in Verizon in 2006. With Verizon investing $10,000 in 2006, you would end up with $42,000. But investing $10,000 in the S&P in 2006 would only end you up with $40,000, so $2,000 less. The compounded annual growth rate is 9.99 with Verizon and 9.66 with the S&P. And then both the best and the worst years for the S&P and Verizon are both better when you look at Verizon's numbers comparing it to the S&P 500. So that is what's really interesting here, is that when you look at these dividend paying companies, why are they better performing? Why does just that 3 or 4% dividend make up for a better return in the long run? Well, that has to do with the dividend stock history, because this company does not pay a fixed rate. Right now, I believe it pays around 63 cents every single quarter, and that 63 cents will not stay 63 cents. Next year, it might be 65. The year after that, it might be 70 or 72 or whatever the case may be. And you see this bold number, the total for 2004. Let's go back all the way to 2004 and see how this company has continually raised its dividend. $1.54, $1.62, $1.62 again, $1.67, $1.78, $1.87, $1.92, $1.97, $2.03, $2.09, $2.16, $2.23, $2.28, $2.33, $2.38, $2.43, and then so far in 2020, they paid $2.48, and they're on track to beat that again here in 2021, gonna be over $2.50. They steadily increase their dividend payments, and that's why an investor, you are continually making more and more on your money, and not only do they continue to raise that dividend, but the share price goes up as well, and that's why you see this steadily increasing chart over time, to where regardless of where the dividend payment goes, usually a company that creates this much cash flow, this much profit, typically goes up in share price over time. But not only is that dividend increase very impressive, I want to show you some financial highlights for this company. In 2020, they produced revenue of $128 billion, and then they ended up performing on the bottom line, paying out over $10 billion worth of dividends to shareholders. And if you look here, this highlighted portion that I'm showing on my mouse right here, of the Fortune 500 customers, they served 99% of the Fortune 500 customers. So think of any large company, extremely large company out there, from Walmart to Target, Microsoft, Apple, Amazon, Google, Netflix, Berkshire Hathaway. All these companies use Verizon. They have their cell phones, they have their telecommunications services, and that's why they serve some of the largest customers in the world. And when you have such a dominant footing like that, serving 495 out of the top 500 companies, you're definitely going to be successful. And they serve over 150 companies. And if we scroll down here and we look at their key financials for 2020, their diluted earnings per share was $4.30. But right now, they're only paying about 63 cents a quarter. If you take that to an annual basis, that's about $2 to $2.50, okay? But if you look at this, they're making $4.30. So that gives them opportunities to have capex spending, capital expenditures, to reinvest back into their business or to pay off debt, or do whatever Verizon's wanting to do with its extra cash flows. Their net cash from operating activities was $42 billion. Capital expenditures, just like we talked about, was $18 billion. They paid those quarterly dividends, and they continue to also buy back shares as well. And then if we go over here to the annual report, I think it's really interesting to see a lot of these numbers because you know me, if you watch my channel, I'm a numbers guy. I like to look at the financials. I like to look at the quantitative analysis before the qualitative analysis because if a company doesn't have the numbers right, they can't have the business right. And this company has both the qualitative and the quantitative. So let's talk about the quantitative for a second. Their operating revenues, this is the negative of the company, okay? So if you look at a company like Verizon, you probably think of it as a company like, for example, AT&T. And you'd be right in saying that this company has to compete for the same customers. It's hard to see a company like Verizon growing massively. And I have to tell you, they won't grow massively anytime soon. A company like Verizon is going to just steadily increase over time. 1, 2, 3% revenue growth in the long term. And that's why companies like AT&T have struggled in these recent years competing over the same customers, and that's why Verizon has just been a steady, slow grower and no massive growth whatsoever. So you'd be 100% right in saying that a company like Verizon, it is not expected to grow any kind of massive amount, 20 or 30% over the next 5 years, okay? So when we look at these, their net revenues, this is the negative, it has basically stayed flat. It was $131.6 billion, and then it only went to $131.8 billion in 2019 on a 5-year span. Not much of an increase there. Not even really worth spitting at. Not even enough to even really pay attention to, okay? If we look at their net income, their earnings per share basic, if you look at that, 5 years ago was 438, but it steadily increases all the way up to 466, okay? Their net income is looking a little bit better. And then what's more important here, when we look at a company like this, I want to see that they're constantly reinvesting back into their business. Because with a company like this, when it's hard to compete for customers, they have to reinvest back into their business, or else they're not going to be able to maintain these revenues in the long term. So let's look at their total assets. Their total assets has steadily increased from 244 billion to 244 again, to 257, to 264, and then a massive jump up in the previous year, all the way up to almost $300 billion at 291. So their total assets have increased year over year. And while we talked about the net revenues pretty much staying flat, just pretty much the same year over year, I want to talk about their long-term debt. This has actually decreased over the last 5 years from 103 to 105, 113, and then they steadily decreased it over the last 2 years from 105 all the way down to 100. So they steadily decreased their long-term debt and they increased their total assets, even though the revenues didn't really hardly budge at all. That's because they're becoming more profitable and leveraging those assets the way that they should be. And if we scroll down here, I want to show a few other things. Remember how we were talking about performance for the S&P 500 and Verizon? If we compare Verizon to the S&P 500 Telecom and just the S&P 500 in general, you can see the performance is pretty much at the top, comparing these top 3 charts, and you can see that an investment in Verizon in 2014 would perform better than the S&P 500 and just right behind the S&P 500 telecom services. So pretty good return there. And if you want to see those results like we were just talking about, when you look at their revenues from 2018 to 2019, hardly budged, not really enough to even worry about, but their operating income increased massively. Their net income increased massively. Their cash flows, which for me as a dividend investor, this is very important. This number right here, their cash flows from their operations increased year over year, as well as their capital expenditures. So this is where for me as an investor, I see opportunity. This is where I see value as an investor. While they're not increasing their revenues massively, they're increasing their cash flow, they're investing back into their business, and the operating income is coming at incredible paces alongside the net income. And if we look at these numbers, I want to show the cash flows. If you look at the free cash flows year over year from 2018 to 2019 in millions, it went from 17.6 billion up to 17.8. Not only did it increase, that still increased while they were investing more into their business in the previous year. So if you see their net cash providing from operating activities, basically their day-to-day operations providing telecommunications services to customers, it increased year over year. Okay. But if you look at their capital expenditures, they invested more into their business in the previous year and still ended up with more free cash flow on the bottom line. That is what I like to see. And so that's when I see a company like Verizon, when I see a company like AT&T, for example. When I look at AT&T, I used to own AT&T. I sold it because the company continues to invest its assets into investments that are decreasing in value. And the companies that it does have that are actually successful, like HBO Max, they constantly find ways to butcher it. And that while its high yield is really attractive, it has no real upside opportunity unless they can increase those revenues dramatically, because it pays out 90 to 100% of its earnings every single year. But when we look at Verizon, it is only paying out about half of its earnings. So this company could literally decrease its profits by half. It could cut its profits in half tomorrow and still afford to pay that dividend. So that's why this company has plenty of room to raise its dividends slowly over time, just like they have over the last couple of decades. And that's why the share price has a lot more room to run. And while 5G is hard to predict and it's hard to know how much benefit Verizon will get from this, it might be a little bit of a wild card, but I think it's definitely a benefit rather than a negative for Verizon. And regardless of what 5G has to do for this company, when they continually increase their bottom line numbers, they find ways to slowly increase revenues through raising prices and a benefiting economy. I think that Verizon will be a winner for the long term. And that's why I don't talk about this company a lot, because not a whole lot happens to it. When we look at companies like Broadcom, or they're constantly re-innovating their business and finding new products to come out with, Verizon, it doesn't do a whole lot. It's boring, it's old. This is the type of investment that you see a 70-year-old man make. But the reason why I invest in it is because it's steady, it's predictable, and its cash flows are about the most predictable as any other investment in my portfolio. So thank you guys so much for watching. I'm going to continue to buy Verizon as well as these other 23 companies listed. And if you want to sign up with M1 Finance or see my portfolio down below, like I said, link in the description. $30 just to get signed up. So if you want to go ahead and do that today, you can get $30 free for getting signed up, and you can help follow alongside with my investments and my investing strategy if you subscribe to the channel. But thank you guys so much, and I'll catch you guys next time.